Inventory in the Treasure Valley declines for the fifth straight consecutive month in most cases, while housing makes a rebound here and nationwide regardless of the high interest rates. Here in the Treasure Valley, pendings and homes sold are on its second consecutive month straight of incline. And we are seeing intermingling between inventory and pendings, which dictate stabilization. Is the median home sale price starting to reflect stabilization? It is. But is the stabilization we're now starting to see in most cases in the median sales price just an illusion now that the mortgage interest rates are back into the high sixes, low sevens? And is the recent uptick in real estate sales here really because buyers have a fear of missing out of its old real estate glory? Or do buyers actually see that real estate is just going to get about as good as it's going to get? Furthermore, can we expect the market correction to continue, and if so, for how long? According to the Dallas Fed, housing prices might have to decrease another 19.5% to get in line with U.S. fundamentals. However, their predictions are riddled with maybes and possibilities. And they further admit that rapidly deteriorating affordability does not necessarily imply a housing bubble. So what is affordability going to look like, and how is this really going to all play out right here in the Treasure Valley? We will get to this and more in this episode of Mikey's Monthly Market Updates for February of 2023. Welcome back after that quick break, everybody, and welcome back to Mikey's Monthly Market Updates for February of 2023. My name is Mike Petrus with MPRE Residential, powered by Next Home Treasure Valley. And of course, in this video, if you are used to this, we're going to go ahead and break down what happened in the real estate market right here in the Treasure Valley. And we're going to dive into a little bit more, talking about mortgage interest rates, what's happening, predictions that are coming out all over the place that's going to happen in the housing market right here, and how it can trickle down and affect us. And then of course, at the end of this video, please stick tuned to it. We're going to go through strategies that if you're looking to buy, sell, invest, or you are currently renting. So let's get to the meat and potatoes, start off with the data, and see what happened in Ada County for this month. So given that we're probably going to have a lot to go over in this video, let's go ahead and start breaking down Ada County and kind of go through this as quickly as we can, is probably what you're used to in prior videos. So let's dive in. And diving in, if we go ahead and take a look, we can see that the median versus average sold price here, or the median sales price for Ada County, is sitting at $492,115 for this month, which is now down 18.2% since the market correction is $602,250. Down 8.8% since the beginning of 2022 when it was sitting at $540,000. And we are now going on the upward scale since that little 481,208 that I put out there towards May of 2021. We've actually ticked up since last month, and we've hit 2.2% overall. Looking at the month over month, yes, in total single family homes, look at this. I mean, really, if we're comparing all the way back to November to really what we got today, 525, 515, 587, 592, we went up, and we actually went up 0.93%. Now, I know that that's not very significant, but it is still heading up. And if you can kind of see what's really been happening over the last months, it's really kind of slowed down from the pace that we were going late May, early June. So what does this tell me? Stabilization. Really, why are we starting to stabilize? Well, it's because right here, if we're looking at the total actives versus solds for February 2023, now that number 1,011, that's actually reflecting the pendings. It was just really hard for me to get the real number at 1,052 that's sitting at the actual inventory that's sitting, because it's just so close together. Oh man. But either way, what I want to point out here is that the inventory has come way down, and we can see that it's now starting to intermingle with the pendings, like I said, in last month's. And we can see that the actual pendings have ticked down, probably because the interest rates bumped up. But we're probably going to have a little bit more of a lag effect to that. But what I want to get back to here is looking at 2019. If you're looking back in January, April, July 2019, we can see that those two numbers are intermingling themselves. And when they do, what does that spell? Stabilization. So is it here, especially with the total single family homes in Ada County? I believe that it is. And we can actually see too, if we're looking at the solds went up to 613. Because our pendings also went up the prior month, it reflected, and people are coming back into this market. Another graph just to quickly kind of show the swings that we've got Of course, during the pandemic, we got all the way down to 6 days worth of inventory here in the Treasure Valley, which is nothing considering that a normal market is considered 6 months by definition, even though we're in a buyer's market. We'll get to that here in a few. But we can see just that swing coming down in 2020, 2021, and then it went all the way up in the inventory, and now it's coming back down to a baseline. Looking at the existing home inventory here in Ada County, again, same thing, even though the existing homes, it's kind of going now sideways. Okay, and can we start anticipating these numbers to maybe come up a bit as the Q2 hits and really the real estate season begins? Yes, I can see it starting to swing the other direction, but not in kind of the volume. And what I want to do is I want to go ahead and put this video up above. I want you to go ahead and click on it. This is the video that I went through last week, talking about how much inventory that we think we're really going to have this time through in this season. So please watch that video and kind of come in line to my thoughts on it. But as we can see, the existing home inventory also came down, again, kind of went a little bit more sideways, sitting at 535 available homes on the market. And we still have a little bit of that gap in this particular category between that and the pendings. But you can see the pendings kind of tapered, probably because of interest rates going up a tick. But we could see the solds definitely bounced up, sitting at 359. Looking at new construction inventory, again, inventory, boom, coming down in Ada County, sitting at only 511 available homes out in inventory in the new construction field. And we can definitely see that the pendings again went sideways, probably interest rates again, just trying to drill this home because we're going to get to it at the end of the video, but we're starting to intermingle. So what is really happening here? I see stabilization definitely in the new construction, and we saw that in the total single families, which do make up existing homes and new construction. And again, we have another bounce up, sitting at 254 homes sold in February of 2023. So again, playing the good old game that I always play for both Ada and Canyon County, who was the biggest loser in overall median home price? Well, but it's also who maybe kind of stabilized in median home sales price between existing homes or new construction. So let's go through existing homes here in Ada County. If we're taking a look at the median versus average sold price, we see that we've just kind of ticked down a little bit from last month when it was sitting at 479,800, sitting at the 472 that we're at. So we're actually just down in existing homes 1.62% since last month. If we're looking since the market correction, sitting at 586,750, we are down 19.5%. And since the 515,100 that we had in January of 2022, when things started kind of going on the up before the market correction hit in late May, early June, it came on the way down. We are down 8.4% since January of 2022. So now let's take a look at new construction. And as we can see, new construction, boom, the median sales price went way up, sitting at $529,990 compared to the $494,900 that we had last month in this category, which is up 6.62%. Now, the builders, why? Because they really retreated back to the pre-solds. They really kind of got rid of their spec inventory that they had that you can just go and buy. So if they're kind of controlling their own supply that they have out there, well, they're kind of controlling, waiting for the demand to go up and controlling really their own price value on their homes. So it's a strategy that they have, and it also allows them not only to kind of maintain the value that they have overall, but it also allows them to take the concessions off the board. So if you're looking in new construction, don't think that this is not a strategy, because the builders are really doing it. But if we are going back, and heed my words on that, looking at the 690 that we were at the top of the market correction though, in Ada County, new construction is down 23% since we were sitting at that. And if we're looking at January of 2022, when the median sales price was sitting at $588,945, we are down 10% since then. So really, who is the biggest loser? Well, if you even want to consider, being a loser in this aspect, existing homes have basically stabilized in this category. And as we can see, new construction has made a jump up. So we'll just have to continue to watch those months, but I would anticipate those to stabilize too, especially as the pendings and the inventory intermingle, which we saw in the inventory in new construction. Getting into the days on market for Ada County, we can see that it just ticked up a couple from last month. And I'm sorry, I messed up last month saying Canyon County's number when it was actually Ada, because last month it was sitting at 71 days on average that the house was sitting on the market. This month it's sitting at 74. But now that we're coming into the seasonal swing, Q2, Q3, we can probably expect this number to start ticking down. And looking at cancels and expireds again, boom, another shot in the cancels. Things are selling in the existing markets. There's really not a lot of cancellations are going on. Buyers are in a lot better position. They know their finances coming in compared to the mortgage interest rates that are coming out there. So really a lot of these transactions are getting from start to finish without cancellations because of the interest rates jumping up. But I also want to pay attention to this data come next month. So please stay tuned for that, because now that interest rates have basically made a full point jump or a 1% jump in the last month, then we want to go ahead, or 100 basis points, shall I say. But either way, we'll see if that ticked up the cancellations a bit, which I anticipate that they will do, because I think that's going to take away some of the buyers that are available out there, which we'll get to the market correction talk that we talked about in the beginning of this video when I hit the mortgage interest rate section of this video. So please stay tuned. Okay, Canyon County, let's go ahead and let's dive into you, and let's go ahead and take a look at what's going on. And looking at the median and average sold prices, again, we can see we're going sideways, even though we kind of ticked down a little bit from last month. But we are sitting at 389,945, which since the market correction at 576,500, it is now down 18% in total single family homes since then. And if we're looking at the beginning of the year when it's sitting at 424,900 compared to today, we are to January of 2022 to today, we are down 8.22%. But if we're kind of looking about what happened in, what was it, about April of 2021, we were sitting at 386, and we've actually gone up since that 1%. And looking at this graph, the 6-month overall chart, we could see really stabilization is here when it comes to total single family homes in Canyon County. I mean, if we're looking at the 415 that we had back in November, and then we had the 390 in December, and the 395, 445, and now back down to 389. Yeah, are we kind of ticking and edging, but we're still kind of going boom, boom, boom. We are going sideways overall when it comes to total single family homes. And when we are looking from last month, from the 395, 445 that was sitting to the 389, 945 that we had this month, we are only down 1.39%. Looking at the total single family home inventory for Canyon County, we notice again, boom, we are still heading down in the inventory, even though it's starting to go sideways, because we are starting to get into our seasonal shift. And please watch the video again above. I just want to go ahead and place that so that you can get to my thoughts on how much inventory I think that we're really going to have here in 2023, right here in the Treasure Valley. So, but if we're looking here, we're seeing at only 647 homes are available for sale in Canyon County as of February 2023. And again, our solds popped up to 396. But if we take a look at those pendings, we see that's going sideways. And again, probably because mortgage interest rates have gone on their way up. But either way, we're starting to see that intermingling again between inventory and the pendings, which is really going to kind of create stabilization. But we'll go ahead and get to that now that mortgage interest rates went up later in this video, so please stick around. And again, looking at this graph, when we got down to 6 days worth of inventory, especially in Canyon County 2, during the pandemic, we could see that the swings went totally whoop. So they went all the way down, and then they went up, and now they're on the way back down. So again, another strong case for stabilization. Looking at the existing home inventory in Canyon County, again, only 313 homes available for purchase, and we can see that the pendings are still going up. They're still reaching that to be able to intermingle. And if we start taking a look back at 2019, when we really did have that intermingling and really the stabilization in our market before the pandemic hit, then we could see that we're starting to return to that. So there's still a little bit of a gap in the existing homes, but it is narrowing, and we could see that the actual solds have made a big jump since the pendings have made a jump over the last couple of months, sitting at 189. So we are getting back to that in existing homes. And then looking at new construction too for Canyon County in the inventory, we can see that the pendings are definitely now starting to kind of supersede a bit of the inventory, definitely starting to intermingle there with only 333 homes available. Again, the builders have basically just dumped all their spec inventory, ran back to pre-solds in that aspect, so there's not a lot of inventory out there. So they're basically kind of setting their own supply and demand to keep their home prices stable, be able to take off concessions off the board, from you. And that is just a business move that the builders do. So keep that again in mind when you're looking at new construction. But either way, we can see that the actual solds have ticked all the way, are ticking up to 207. But we have that intermingling there, which is really kind of saying stabilization now in the prices in new construction in Canyon County. So overall, I did not touch upon this in the overall inventory that we have available in both Ada and Canyon counties. So I just want to touch upon that real quick. So looking at the inventory for total single family homes in Ada County, we're sitting at 1.7 months, which is down from last month. Looking at the existing home inventory in Ada is also down, sitting at 1.5 months. And the new construction inventory in Ada County is sitting at 2 months, which is down. So again, the pattern, you see it in the charts, the pattern on the inventory is down. The gap between supply and demand is narrowing and intermingling with one another. And if we are looking at Canyon County, same trends. Total single family homes is sitting at 1.63 months worth of inventory. For existing homes, 1.65 months for existing inventory in Canyon County, and new construction is sitting at 1.6 months of inventory. So again, this is just what's happening and making another strong case for stabilization. And buyers, keep this in mind as we get to the end of this video. Buyers, this is now going to start swinging this back to where you are actually now starting to lose kind of the negotiation power, the buyer's market that you had available just a little bit ago. But let's play the game here for Canyon County again. Who was the biggest loser out of the total single family homes? Was it existing homes or was it new construction? And if we take a look at this graph over here, we can see that existing homes went actually up here in Canyon County, sitting at 365 for this month from the 339 that it was sitting last month. So it actually went up 7.12% overall. But if we are looking since the market correction of when it was sitting at 425, as of today, we are down 14%. And if we're looking at what happened since January of 2022, when it was sitting at 390,000, we are still down 6.41%. But the median sales price definitely made a jump up in existing homes. Looking at new construction in Canyon County, again, boom. Okay, just kind of went horizontal a little bit up, sitting at the 419,900 that we had last month, or today that we had since last month at the 415,450. So we are up a total of new construction in 1% since last month, but we are down from the 549 that were sitting at the top of the market late May, early June, down 23.5% since the market correction, and looking since January of 2022 when it was sitting at 465, we are down 9.7%. So who is the biggest loser out of the two in Canyon County? Neither one of the two. Okay, and actually they both went up. So, but do I expect them to start, kind of going up and down and basically stabilizing as we go, as we take a look at the inventory? Yes. So in the majority of the categories, both in Ada and Canyon County, are we seeing stabilization return to the Treasure Valley? According to the data, we absolutely are. Looking at the days on market here in Canyon County, boom, made another tick the other direction, actually. We're sitting at 83 days. Most likely just because of the seasonal quarter four, quarter one deal takes a lot longer, less buyers out there in the market. But we can see that the buyers have definitely started to return. You can see that in mortgage applications across the United States. They are definitely on the rise regardless of where the mortgage interest rates are really sitting right now. But we have ticked down to 76 and anticipate this number to start ticking down as the seasonal inventory or the seasonal shift in real estate starts. And then lastly, looking at cancels and expireds, again, the same trend as what we got going on in Ada County. The cancels really dipped their way down because there's more qualified buyers out there. They're not really falling out of contract due to where the interest rates are at. So we'll just have to watch that and monitor that for next month now that interest rates again made another full percentage point jump over the last month. So will it take out some of the buyers out of the market? I anticipate that it will, and expect maybe the cancels to start ticking up a bit. But again, transactions are happening here. Things are selling. So anticipate this number to kind of maybe stay where it's at with a little uptick due to the mortgage interest rate. So we'll just have to continue to watch and see. So now let's jump into mortgage interest rates, the state of our current economy, and one of the biggest things really on the plate when it comes to a housing bubble, the fear of missing out. Is the fear of missing out really going to create a housing bubble like the Dallas Fed is afraid of, like it did in the past, especially during times like the Great Recession? This time through, I believe no. In fact, I think that what's going on now in housing is more of the fear of paying too much, which is also corroborated by the National Association of Realtors in this article. So let's analyze this. What would you really be missing out on? A astronomically high return in equity that we had over the last really essence 2 years? With stabilization really now here in the Treasure Valley, it's really going to stick this path for quite some time. Granted, it stays on its true path. For equity and incentives to really return back to those levels here in the Treasure Valley, we'd have to go back to the pandemic. Supply would have to be nothing and demand would have to be big. In this scenario, we'd have to really go back to broken supply chains overall, people out of work or being shut down in the work, and then the demand to be huge. Given this, what do we know? We know that the high interest rates we are currently seeing is keeping the buyer's demand really out of the game from what we had a year to a year and a half ago. This also means a more qualified buyer in the game today than we had at that time ago. Sorry, but it's true. The high mortgage interest rates also means that sellers are most likely not going to sell. Why would they sell to go ahead and move laterally over into a higher interest rate? So in essence, I'm believing that in 2023, this will really basically keep the demand and the supply at a basic even keel, creating the stabilization. Back again, if supply were to head up and the demand going down because of mortgage interest rates where they're at, how would that be fear of missing out? In fact, that'd be quite the opposite if home values continue to go down. So if anything that's really happening right now and why buyers aren't returning is because they do have a fear that they're paying too much. Furthermore, if we look at 2008 and the subprime mortgage crisis that we had, people were basically grabbing interest-only loans in order to cash in on the equity in pretty much such a short term. There was an incentive of missing out, and those days, due to the Dodd-Frank Act, are over. So going back to our market where we're currently at, where's the mass exodus of buyers that isn't already there, and where is the mass inventory? It's really not there. So do we see equity returning anytime soon, and especially to levels that we saw during the pandemic? No. And although the truth is we don't exactly have a crystal ball of what's going to happen in the future with our markets, it seems really highly unlikely that that scenario is going to play itself out again, minus another pandemic to shut everything down. So will the fear of missing out really create this huge influx of buyers coming back to our market to potentially create another housing bubble? Well, I think it kind of speaks for itself. But the fear of paying too much, that's a discussion to be having. So now let's take a turn to affordability since we're on that subject. According to the Atlanta Fed in this chart, we can see that affordable housing is hit a level that we haven't seen since 2007. Absolutely true and undeniable. But why? Well, really, it's because of where mortgage interest rates are. Where at the time of the market correction, it was a little bit of both, the housing value and the mortgage interest rate. And why are mortgage interest rates teetering up right now, say compared to just a month ago? It's because the data numbers are reporting that inflation is kicking back. In what areas does the core CPI and the core PCE look at that the Fed really pays attention to? Goods, services, housing, and jobs. Let's tackle these one by one. According to Jerome Powell from his recent Senate hearing, it's not because of goods and broken supply chains anymore. He says they've essentially been fixed. And what else do we know? We know that China is coming out of their lockdown protocol, which provides about 18% of our imports here to the United States. That can be a good and a bad thing for inflation. It's not housing for too much longer. Why? Because the OER, which basically is a comparison between rents and housing mortgages, more leverage giving to new rental leases, is coming down. In fact, the Fed is saying that housing should come back down to acceptable levels of inflation come mid-year. And as we can see by these graphs, the rents and even the OER is starting to come down. So are these very same home affordability charts that we're seeing according to the Atlanta Fed. And these available charts are a little bit behind. As you can see by according to this graph from the Atlanta Fed, what is the majority of the chunk right now making homes unaffordable? That's right, mortgage interest rates. So do I feel, according to the data, that the mortgage interest rates might create a lag and maybe a potential continued devaluation of home prices here in the Treasure Valley? Yes, I do. But is this really going to hold for a long time, and is this going to be a big giant pain that's going to keep mortgage interest rates where they're at? Just remember, a short month ago when they were in the sixes, buyers were still coming out of the woodworks, and that was the least volatility that we saw in mortgage interest rates in quite some time. So will there still be buyers out there even in the sevens ranges, the low sevens ranges? I anticipate that there will be, just not as many, which could result in ticking down our home values still a bit. But if we look at the numbers, especially of this one from the core PCE, really did the inflation kick back at just this extreme number And if we're thinking about the non-farm payrolls that really kind of started this back on the 2nd of February, it was really because they made a mathematical seasonal adjustment. And I believe that seasonal adjustment really kind of got trickled down into the rest of these reports. So will this kind of correct itself, and will we see disinflation probably continue to happen sooner than later? I definitely anticipate that to be the case. And what will that do? That'll bring more people to invest in the bond market or the 10-year Treasury note at this point. And when those prices go up, the yield comes down. And what can we expect from that? Mortgage interest rates to come down. And as long as the mortgage interest rates are coming down, we can expect buyers to return. But we will have to just wait and see. And if you would like more information on how this really affects one another, please click on the link below. Visit my video from last week. So taking a gear back to what we were talking about, let's also take a look at real disposable income right now. From a comparison of nominal to real income, we can see that real income is actually on the way up, which is not what the Fed wants either. Even though they said it's been ticking down, and you can see that this graph is a little bit behind. But we know, I do know because I follow, that the real wages that people are taking home are ticking down. However, what I also know though is that there's a 2-to-1 job availability right now out in the markets. In fact, actually, our market participation in employment is at 62%, some of the lowest we've ever seen in the nation. So what does this mean? And it's also what the Fed doesn't want to see, is it means that the employee can go to the employer and negotiate a higher nominal wage, which can turn into more spending, more tossing money out in there into the economy. And again, we could really see that in the areas of what? The services, because people, according to their data, are spending more money at places like restaurants, medical, financial, leisure, travel, etc. And according to the Senate hearing, this is the one area that the Fed really wants to tackle, which makes up 56% of the core CPI report. And what he was really kind of being grilled on just a little bit further was, do you have specific tools from people from the Senate and even the House asking him to be able to combat, let's say, services on its own, housing on its own, etc. on its own? No, he doesn't. He's got one really big, giant, blunt tool, and that is the federal funds rate. And if he over tightens this sucker, which I think that he already has, because the federal funds rate has a huge lag before the effects really get seen, then he can land us right into a recession, which I kind of believe is almost 100% guaranteed at this point. Why? Because they're going to continue to raise the federal funds rate, their only tool that they have, and they're going to hold on to it for longer. But is everything going to fall apart? The answer to that is really, it's really not going to. And how do I feel this way? Because really, there's a tightening in the labor market right now, as we know, a 2-to-1 job differential. And really, the employment levels, people that want to participate are not there at 62%. They even got on to the topic of immigration, like, can immigration help solve this? Well, there's a yes and no to that. But if the effects of a recession actually hit, it will force the Fed to loosen its monetary policy to get the economy back online, which means lower mortgage interest rates, people returning to jobs because companies will be a lot more willing to hire because they'll have disposable income, and innovation will also pick up here in the US. If that comes now, will it come with a higher interest rate as compared to, say, if they kind of really hold this on and really bleed us all out? That's a true story. But really, what is the real average of inflation that we've had here in the US? It's over 3%. And just remember that the 2% benchmark that the Fed wants to hit is something that is globally accepted and accepted right here within the US as their standard. So also trying to get us there can result us in a recession over tightening. So in the meantime, Americans are definitely feeling the interest rates, and they are definitely feeling everything when it comes to inflation. And yes, we are feeling more at the grocery store. We're feeling more at the pump, and the pump reflects at the grocery store, etc., etc., etc. In fact, gas basically kind of comes down to everything if you want to talk about inflation. But unfortunately, this is not an area that the Fed is concerned with. Core PCI and core PCE reports keep out the volatile food and energy sectors. In reality, does this make affordability harder on your everyday American? It sure does. Given everything we're feeling right now, people are still returning to the housing markets to buy. In essence, is life moving on and people are moving forward in their lives to be able to cope in this economy? They are. And will it get worse before it gets better? It will. So do I really see extreme catastrophe coming up here, for Americans overall, with the housing creating a bubble, a severe crash, all of this kind of stuff? Well, according to the data that we've got right now, and considering really where we've been at, I really do not see that happening. The more and more that I look at this and a potential recession that could be coming up, it's because this recession would have been basically created by broken supply chains and no goods. And those are really kind of been fixed in itself. And I think that everything's going to find itself maybe a happy equilibrium now, more than I look at it, that the Fed could potentially have a soft landing, but that of course depends on the lag of the federal funds rate. Again, where I think jobs could potentially be at with the recession just coming back to a full just equilibrium baseline, a loosened of the labor market, etc., which the Fed also thinks. I honestly think that this recession will be a little bit way on the softer side than probably what we are used to here in the United States. And according to this article, they also agree to the same. In summary, and what I really want to kind of nail home for everyone that is watching this video, have we ever seen in recent history prices actually go down? No. Have things always gotten harder on Americans? Yes. Has inflation gone up 20% and wages only gone up 10% in the last 10 years? Also yes. Have Americans always survived? Yes. Although there's a lot of worry that's really kind of happening in the U.S. right now when it comes to our economy, inflation, etc., I believe that this will kind of move on from itself. We will continue and we'll see the pattern that I just discussed here. And according to the data right now, things are still moving in the direction that we really should want them to move in. And will this get worse with debt that we hold on a personal level, corporate debt, federal debt? All of this, is it going to get worse over the next 10 years? You bet your bottom dollar. If you have any further questions regarding any of this, my thoughts, please feel free to reach out to me. More than happy to have a nice conversation with you. Or please comment below. Would love to hear your thoughts on where you think this is all going coming up in the future. Okay, so given the data that we have today in today's real estate market, just kind of not guessing on maybe possible future predictors, even though you should really be thinking about it. Think about what was going on with the mortgage interest rate discussion that I just had. What is going to be in store for buyers, sellers, investors, and renters, and what are the best strategies to go ahead and succeed in today's market right now? Buyers, let's go ahead and start off with you. Buyers, of course, right now, as we know, mortgage interest rates jumped up another whole full point, which just means it's going to cost you more money if you need to obtain a mortgage. But we have noticed still that there's people returning. We're still seeing the uptick in the mortgage applications nationwide. We're also seeing it in our data that we saw earlier in terms of the pendings. We're also seeing that the inventory is coming down, which is stabilizing this market. So if you're anticipating that home values are going to continue to crash down or continue to go down, I've got my doubts. Okay, even given where the mortgage interest rates are, that home values will continue to come down in a decrease of even what the Dallas Fed is talking about at 19.5%. I just kind of got my doubts, but we'll have to continue to wait and to monitor the data as it comes across. And of course, that is the decision for you as the buyer when you're out there buying. Do you want to take that gamble, or do you think that it's still going to be coming down in value? What I'm guessing is that this is going to be a small little dip, if anything, in the values due to the numbers, because as we saw in the mortgage interest rate section of this, really have the numbers really bucked back against to really show that inflation is still out of control. And really the answer to that question isn't. And even if the federal funds rate gets over tightened to the point where we fall into the recession, they will loosen their monetary policies, mortgage interest rates will come down, and there you go. You can kind of do the math for itself. But if you're looking to succeed in today's market, we do know that the concessions are starting to come off the table. We're starting to know that the buyer's window, the buyer's market that we had just a couple of months ago when the inventory was actually sitting at around 3 months worth of inventory, we knew that really sellers were coughing up concessions, opening up that buyer's window, giving you a lot of negotiation room against the seller. Well, that window is starting to close. So if you are trying to come into the market right now, I would say come in sooner than later, because that can actually close the window in its entirely and create an even playing field between the buyers or sellers, or even give a slight edge back to the sellers, which will really kind of hurt your negotiations overall and any kind of concessions that you could possibly get today. In fact, you might have even missed that window. So buyers, if you are looking to buy right now in today's market, feel free to reach out to me. I'd love to discuss what it is that you're looking for in a home, areas, etc., your price point, whether or not you're looking for a mortgage, and discuss the best strategies to be able to get you the home of your dreams right here in the Treasure Valley. Sellers, your turn. Well, you're starting to get the leeway of that power back as this starts to narrow itself between inventory and buyer's demand. Will more shift to an even playing field, or even bring you back a certain edge. In fact, probably some of you sellers right now that might have your house on the market has noticed that you're probably taking back your concessions, much like the builders have. That's up to you in terms of how you want to compete against comparable properties out there to get somebody to your property. That comes to really the motivation as to why you're selling the home. But as I've said before, really sellers, most of you, if you're considering it, are probably saying, well, I'm not going anywhere because I don't want to deal with a 6 or 7% interest rate. You're like, wait a minute, I'm locked into 3% right now. So most of you are probably going to stay put. But again, usher in the age of where you have to sell for necessity. Maybe you've got to move because of your job, or maybe you've got to move because you want to be closer to family, etc., along those lines. That is probably going to be the primary motivation of most sellers out there today. So sellers, this still isn't a year and a half ago to where you really had the power to basically ask for whatever you want. I'm being facetious, of course, but that's how generally it was, because you had so many buyers out there trying to grab up little to no inventory, and your sale was more or less mutually assured. But even coming into stabilization, which we are seeing in the data, is still key to appropriately price your home for this market, and the buyers still have a little bit of an edge over you for now. So sellers, keep that in mind. It is key to appropriately price your home. And if you would like to discuss these strategies and how to be able to sell your house for the most money, even in today's market and in the quickest amount of time possible, please feel free to reach out to me. We'd love to be able to set up an appointment and come on over and discuss the best strategies for you. Investors, your turn. Well, this one's actually kind of an interesting one for you, considering that now the OEM and or the OER, I apologize, is being adjusted, and we see that rents are coming down here in the Treasure Valley. The federal funds rate is really kind of getting its way to be able to adjust that with housing, and the Fed is still saying that it is coming down, and they expect it to stabilize come around mid-year. So maybe around then, and maybe if the mortgage interest rates kind of tip down some of the buyers in the aspect and be able to continue to keep home values coming down, or say there's, catastrophe on a global aspect, et cetera, we head into recession, somehow it doesn't. I just kind of don't see it personally. But if there's something you'd like to share with me, please comment below, investors. Would love to hear what you think it is that I'm missing. But either way, you might be waiting saying, well, maybe I think, home values are going to come down a little bit more. Or especially if you have to get a loan in order for your secondary, you know that right now the mortgage interest rates are high. And if you do go for a secondary property, they're going to be a little bit higher because it's a secondary property. That will also chip away your capitalization rate. So, but if you're out here buying in cash, you're really kind of in a great position right now. Maybe you might wait again until the rents have kind of maybe bottomed out, or maybe you're trying to get in there right now while you can still hold your rent value, which I highly suggest that you do. But maybe you're trying to see how things kind of filter out with values. Either way, it is an interesting time for you investors, but considering where the rental values are right now, and we do know that they are still coming down, if you're looking for that secondary property to be able to go ahead and lock into somebody into a lease and maybe get a better capitalization rate as it comes through, now may be a better time than say maybe waiting until mid-year. But also if you are going for a loan aspect of it, your capitalization rates are definitely going to be hurt by the higher mortgage interest rates and that little extra that they tack on because you're a secondary property owner. So do your numbers. Call me if this is the situation that you're in either which way. Would love to be able to run the capitalization numbers for you and let you know where you're at. And if you are in the flip game, just to let you know, out there, a lot of those deals have definitely shored up because the inventory has come down. And we're returning back to that stabilization to where sellers might start getting back their edge to be able to kind of more or less hold you to any negotiations that you had before, to be able to kind of maybe hustle down the price a little bit to get yourself a better rate of return when you went to sell the property. So investors, I do look forward to hearing from you. And last but not least, renters. Of course, as I say it every single time, you are paying a 100% mortgage interest rate. It's because you are paying your landlord instead of maybe trying to get any equity, out of the self. Now, I still kind of believe that prices, I've seen a stability. We might have a little lag, here, but I generally kind of think that this is where the markets are going to be going, considering everything, wage growth, inflation, etc. I just kind of think that this might be the new norm if you're looking for property values to really kind of tank down. I just don't see that really in the cards itself. But either way, renters, why pay your landlords to basically put money in their pocket when you can go ahead and try and do that yourself? Will it come up anytime in the near future to where I think you're going to make equity gains? And will you see equity gains that we saw a year and a half ago? Unfortunately, no, unless if another pandemic just happens to hit itself and everything shuts itself down. But renters, if you are tired of paying rent, you want to have something that's an asset of your own. And remember, when you add that asset, you are going to be worth a lot more money than if you are just basically renting, in itself. They say basically the savings in itself is about a $200,000, difference from when you actually own a home to a $5,000 difference as to what you basically kind of have in yourself. So if you would like to go ahead and invest in that asset, please feel free to reach out to me. Let's go ahead and let's talk to a mortgage specialist today about the right timing of this stuff, setting up the perfect plan for everything for you to be able to go ahead and get into the home of your dreams. So renters, I look forward to hearing from you. Lastly, the one little piece that I'd like to touch upon here is talking about something that I always do that you'll be able to refinance later on down the road. Okay, so even if you purchase right now, our home value is really going to dip down, to a point to where it really affects your 80% loan to value deal that you have going on, to where you have to bring in more cash to be able to refinance. Prices would have to really kind of drop in order for that to, happen to the point to where refinances are going to be an issue for you. Plus, on top of that, you're actually paying off your principal mortgage too. So also keeping FHA and VA streamlined guidelines basically out of this one, could you be able to refinance popping up, even if we take, some small maybe dips overall in the value? Yeah, you should be able to call me, discuss out, reach out to your mortgage professional as well. But again, remember, you are purchasing the home and dating the rate here. So, and if you have any further questions about that, be more than happy to put you in contact with an awesome mortgage professionals out here in the Treasure Valley so that you can discuss that possibility coming up. Well, thanks again very much, everybody, for taking the time out of your day to watch this video. I hope that you did find the information useful. Please comment below. Oh, and hey, look at that. It's a subscribe button. Please hit the subscribe button. Hit the notification bell so that you're constantly in tune with the videos that I do come up with. Love to see you definitely return. And please feel free to reach out to me if you're looking to buy, sell, invest right here in the Treasure Valley, or click down below into my relocation guide link down below if you're looking to move in from out of state, so that way you're in the know before you decide to make the move. Well, thanks again very much, everybody. I look forward to speaking with you. God bless. Until then, thank you so much. Bye-bye.